Well, big picture with Ravi. We're calling this show as a differentiated show because Ravi's been a big supporter of ET now, and it gives me so much of pleasure, thrill, and excitement to see the investment journey of Ravi and his firm. It started with very humble beginnings to a powerhouse now. When we first met, I think the AUM was less than 100 crore. Today, you just add two zeros, 100 has become 10,000 crore. CAGR return absolutely fantastic. Market beating returns in terms of the quartile. So last couple of years, even though it's been full of twists and turns because of COVID and for markets and where macros have moved, I guess there is one firm which in a sense has really managed to navigate the waters. They have held out in terms of their thought process. And it's not about the size. I think it's the number of satisfied customers what ValueQuest in a sense today is commanding, and the respect they have within the investment community is fantastic. So Ravi, I remember our first interaction 2013, and from now to here, it's been 100x for the firm.
Yeah, thank you, Nikunj, for that introduction. I'm not a very superstitious fellow, but I do believe in maintaining the humility for the returns and the AUM growth that we have seen. All those kind of things get into your head, and that can be harmful for the future returns. So anyway, we'll pat ourselves on the back the day. Our job is to generate returns for the clients, and that's what we want to focus on. Everything else is just output of what we do.
Okay. 35% CAGR return, 35% plus CAGR return in last 3 years, 20% plus CAGR return. That means in the last 10 years, you've become 10x. If this 20% CAGR return continues in 20 years, you could become 100x. That's simple math.
That's
right?
mathematics. That's mathematics. I wish life was that simple.
But looking at the India appeal and the positioning of the market right now, 15 to 18% return for next 5 to 7 years, will that be a tall order?
So I'll put it this way. See, last 10 years, markets have thrown everything at us. From the currency crisis, from the global financial crisis, then came the currency crisis in 2013. Then came GST, demonetization, IL&FS crisis, COVID. Everything has been thrown at us, and yet if we have generated 20% return, when index has generated about 12-13% kind of return, I think ensuing 10 years give a lot of hope of being better than what the last 10 years was. Last 10 years had a lot of asset quality correction. There was a lot of putting in place systems and processes at economy level, which kind of held back the growth. Also, there was a major move from informal economy to formal economy. So all that kind of contributed to the growth being lower in the last 10 years. I am very hopeful that the next 10 years growth for the economy and consequently for the markets also should be higher than whatever the last 10 years have produced.
If the starting point is today, which is 25th of October 2023, and if the end point is, let's say, 5 years out, 2028 October, are we in for CAGR mid-teen returns?
So this is what I'm telling clients, those who are incoming at this point of time, that if market does 10, you can expect some alpha from us. However, what I feel confident about is, or what I tell is that, in next 5 years, if we are to generate 15% CAGR, it will not be a straight line journey. Expect at least 2 to 3, 10% kind of correction. Expect 30% correction. It's a given. We don't know what is going to cause it. We don't know when it will happen. But it's a given that these corrections are in the offing in the next 5 years, because last 3 years have been much smoother than they have been in the last 10 years.
You've got 3 categories: institutional investors, sovereign funds. It's remarkable that you're managing money for sovereign funds, touch wood. Then you got ultra HNIs, and then you got HNIs. Is the advice standard to all 3? Because everybody has a different time horizon and a different risk profile.
Yeah, no, so absolutely the advice is the larger institutional capital has far longer horizon, and their mandate is also different. The mandate is to outperform the market. It is not an absolute return, while for an HNI or a family office is more absolute return that matters. So from next 5 years, we feel confident about generating positive absolute return, and we feel confident about outperforming the index also. However, if we were to shorten that horizon to 1 year, then I'm not very sure about generating absolute return. There will be volatility along the way for sure.
Same time last year, on the same forum, you made a very loud call, which is that I'm getting out of IT, reducing my exposure to pharma, and I'm increasing my exposure to financials, manufacturing, and alternate energy. That call has worked. But in financials, some would argue that despite delivery, the gains have not been that spectacular.
No, I think that's absolutely correct observation. The financials, because one, there are many firms available, and this is an initial stage where all the boats are rising. So there is no differentiation between X versus Y. All of them are on an improving wicket. The problems in financial sectors come 3 years down the line to understand who has been aggressive in lending and who has been conservative in lending. So the differentiation probably will happen going forward. Currently, we are witnessing some pressure on the margins, which is also kind of holding back the kind of re-rating which we feel will happen in the financials as well. So I think the supply of paper is too much. There are so many NBFCs and microfinance institutions waiting to get listed, and so the supply of paper plus the no differentiation between firms is, I would say, is leading to overall the returns being still earnings oriented rather than there being any kind of a re-rating. So, but I think we still maintain our positive view, because as long as the earnings are growing and the cycle is in favor, there is no reason for us to be getting out of the sector.
I look at financials and the retail growth is strong. I look at autos, the retail growth is poor. I look at rural economy, that is under stress. So banks are growing, and if retail lending is increasing, what end of the economy is growing? It cannot be only ultra HNI and urban consumption. For India to grow, retail, rural, and the semi-urban also has to grow. The banking data and the real economy data is telling me two different pictures.
No, you're absolutely right. It's been a very uneven recovery, and in our early stage post-COVID, it was a K-shaped recovery where the top end was doing well and the bottom end was not doing well. Some amount of revival we can foresee at this point of time at the bottom end of the pyramid because of the MSP price increases. Monsoons were bad, but they were not so bad as well. Just the pent-up demand in the rural economy. So some revival is going to happen, and you're absolutely right about that. So, and some amount of trickle-down effect also has to happen because of the kind of confidence in the corporate sector, the kind of investments being foreseen, that is eventually going to lead to job creation and going to lead to wage increase. In fact, we are already seeing in some sectors like manufacturing and financials where the war for the talent is getting very high-pitched, and the wages are rising in a tremendous way. So this will eventually hopefully manifest in other sectors as well. It's not as broad-based a recovery that ideally we would have liked. But I'm still a believer that the recovery at the bottom end of the pyramid is also up ahead, and it's not like it's not going to happen. The unevenness of the recovery will smoothen out over the next couple of years.
So, in the terminology in which we often interact, इस market को divide करते हैं, सस्ता और अच्छा मगर सस्ता नहीं, and simple compounder. Divide the market in three parts for us.
No, yes, ability to find sasta or acha is definitely a challenge at this stage. And I would just add third dimension to it, which is the outlook, which is also what we focus on, is growth, valuations, and outlook. Which are the sectors which tick all three? There are very few in that. Some of the sectors that we have been bullish on. So financials definitely fall in the sector that takes the growth, valuations, as well as the outlook being good for the next 3 years.
Sasta, acha or growth?
Sasta, acha and growth. Okay. And outlook being good. So, and the second sector is manufacturing, where the tailwind is strong, manufacturing and capital goods. However, the valuations in the recent past have really, kind of gone through the roof. So some amount of correction consolidation is warranted over there, but the outlook still continues to remain very, very strong. And these are long cycle plays. So I still believe that we are still in the early stages of the cycle. So a correction over there would be a great entry point at some point of time.
You made some investments in the manufacturing space.
Yeah, manufacturing has been a theme for us since a while. So has been energy transition, and so has been capital goods. And we have not had a Capex upcycle since almost now more than 10 years. 2010-12 is where the previous cycle peaked. the gross capital formation in the economy is finally looking up. So that is the number one thing that gives us the confidence. And till now, it was only the central government which was kind of carrying the burden of capex. Now the state, this particular year, state government have also come in, and private sector has also come in. So all the three engines are going to fire going forward in the capex cycle. So yes, some of the valuations have gone up, but it is backed by growth in earnings and backed by growth in order book. It is not complete devoid of reality.
Ravi, what has differentiated your approach is that you're not obsessed with a P number. This is the right P, this is the wrong P. When a cycle is at play, you don't know where it will peak out. Could that be the feature or the hallmark of the boom in manufacturing or the upswing in defense or railways?
So, see, valuations are an art. They are not necessarily a PE number. PE number is a nice shorthand which we give ourselves to convince ourselves whether the company is expensive or cheap. However, you have to juxtapose it also with the kind of growth being witnessed and where are we in the cycle. So if it is an early stage, early cycle, and also the PE multiple is looking more expensive because the earnings are on the lower side, then it is not the same where earnings are at a peak, margins are at a peak, and valuations is at a high, and the companies are probably taking leverage for that growth. Though that is condition that scares us. So right now the leverage is missing. Earnings are more subdued. When I say subdued, it is not that we are still at the beginning of the cycle, right? What happened in the previous cycle from 2002 to 7, when we saw the capex cycle, we actually saw ROEs expand from 10-11% to almost 25%. We saw utilization levels go from 60 odd percent to about 85-90%. So the cycle is still ahead of us. The operating leverage is still ahead of us. The balance sheets are not leveraged. So that gives me, and growth is, again, as we mentioned earlier, it's not like all guns are firing in terms of growth. So there is still a lot of headroom available for growth, margin levers. Hence, valuation and taking the current P multiple and fretting about it can be injurious over a 3-5 year horizon. Again, I'm not saying that we cannot have a year of no performance, or even for that matter, absolute correction also in price. But from a 5 years perspective, it is definitely the earnings still have ability to surprise on the positive side.
Okay, I can understand that tailwind for manufacturing is strong, for energy transition is very strong because of the China plus one factor which is at play. But when it comes to defense, you have ownership in defense stocks. When it comes to railways, since you have ownership there, A, these are not high return businesses, and B, there's a binary risk which is elections. So as a portfolio manager, how would you manage that?
No, you are absolutely right. And as a disclaimer, we are probably trimming in some of those stocks as well, because the returns have been tremendous. And you're right, there is even though the hypothetical risk and probably smaller probability, but there is always a risk. If the new government comes in, the priority is probably likely to change. If there is a continuation of the dispensation, then probably there will be, in fact, even more thrust to the areas that we are witnessing in defense and railway. So reprioritization of the sector for the new government is a real risk that we are carrying. So some amount of taking money off the table is warranted at this juncture, I would definitely say. But from the quality of business perspective, I would say we are probably underestimating the size that these companies can become over a 3-5 year horizon. See, if India was to actually reduce its logistics cost from 12% to 13-14% to about 8%, which is what the global standard is, we'll probably need far more of railway logistics, and that will require far more capex into wagons and rakes and in the entire, which is what is happening, right? We have seen the eastern corridor of the DFC open up. We'll soon see the DFC on the western corridor also open up, and we'll see bullet trains and other electrification and signaling system. Everything is being invested into. And last budget was the first budget where we saw big absolute number as well as a huge percentage in terms of where the money is flowing towards. So I still believe it is still an early stage in the cycle, and these companies can become much larger from a 5 year perspective. So that is why it would be, and I have seen this pan out in multiple sectors, that if you are early in identifying a sector, stick around as long as the tailwind in the sectors are there.
Is that the secret sauce? Because if I historically look at the way you invested, you pretty much like to identify the trend early. Is that the differentiating factor for you?
So there are many ways to skin the cat. Some people buy cheap companies, some people buy cheap stocks. We try to identify which are the growth sectors, growth phase in a company, and then ride that growth phase. So we don't profess on buying companies for 10, 20, 30 years. Neither do we buy for less than 1 year also. So our focus is always on a rolling 3 to 5 years. And I think over there, if you can find a sector and then within that try and identify companies which can actually ride that trend well, is where our expertise lies to some extent. I would say that's what we have tried to do in the last 13 years. And yes, so these are the sectors where the outlook remains positive from 3 to 5 years view, and we'll continue holding that. We are not exiting. Some amount of taking money off the table is absolutely.
They say when there is cherry consensus, you don't get good prices. And defense, railways, manufacturing, ये घर-घर की कहानी हो गई है. Isn't that true?
घर-घर की कहानी तो नहीं बोल सकते, but yes, you are right. It's become more popular. It was an ignored sector probably 5 years back. These stocks were available at 8-10% kind of dividend yield, especially in the defense. Nobody was willing to look at railway. Railway used to be a kind of a seasonal trade where you buy it pre-budget and then sell it in budget. This time around the cycle has prolonged and it is way beyond budget because that change actually happened. See, whenever a new sector comes up, usually there are no dedicated sector analysts in the sell side broking firm. People don't know how to value it. People don't know how to estimate how much the growth can be. So all those things lead to a little bit of overvaluation. And I think that is, we have seen this happen in every sector that we have invested in. 2014-15, we identified chemical as a sector. Now today we are all, the stocks, they were available at single PE digit multiple. They went to 40, 50 PE multiple. The moment they are correcting to 30, now people are saying it's a buy. I'm not saying they are not a buy. In fact, we are not investing. But people have gotten so used to 40, 50 PE multiple that 30 looks like an opportunity to them. So again, that is what I would call a popularity, is that, sustained 6-7 year period, and then suddenly there are new companies coming for IPO in the same sector analysts, sell side brokerage, reports coming one after the another. So those are the things that point to, okay, everybody is now focused on this sector and money is flowing towards these sectors. So we are still in the early stages. Still there is no private sector in the defense. It is all PSU sector only. And at some point of time, some private sector companies will also come. We have seen 1-2 companies come to the market. We'll see many more companies come to the market to raise funds over here as well.
So is that a new idea that buy private sector defense players?
No, so private sector, I think for the next 5 to 7 years, it will still remain a very much a PSU dominated sector. It is a strategic sector. Not everything will be opened up to private competition. However, there are spaces like whether it is drones or whether it is some other small equipment, subcomponents, assemblies, which can be addressed to by the private sectors. And yes, they are going to witness tremendous growth over the next 5-7 years also, but they are still all very small companies. The turnover ranging from somewhere between 50-100 crores to 500 crores is the range. So from a institutional perspective, there are still very small companies, but yes, that is the sector that should do well over the 10-year horizon as well.
Now, when defense started, there were no analysts, there was no coverage, there is no benchmark. But when consumer tech and fintech went public, there were a lot of analysts, a lot of reports, everyone had an opinion. Is that the reason why you avoided them? Because too much of research was available.
No, it's very simple for us. What we don't understand, we avoid. So the valuations over there were a little difficult to understand. We understand that those businesses are good, companies are good. We understand that there is a change that has happened in the Indian startup ecosystem where the companies are reaching a certain size and scale much sooner. A lot of it was also to do with the fact that money was available on tap from the VCP funds. And so the priority for every company was growth and not profitability. Those priorities have changed. The reality today is that everybody is now focused on becoming profitable. And the pitch to now all the PVC funds is we will reach profitability by X quarter or that X year. So that change has happened. But the good thing is for somebody like us is that baby also gets thrown out with the bathwater. So the cash guzzling business models are finding it difficult to survive, but good companies also, which probably don't require so much capital for survival, but it is a growth capital that they need, are also finding it difficult to raise capital. So some of the companies that came to the market to raise capital are at a significant discount to the earlier valuation that were being discussed in late 21, early 22. So I think some semblance of reality has come in, and that is providing some opportunity in good business models for company, fund managers like us.
Ravi, unlike traditional investors who've always shied away from investing in IPO market, you've not done that. You've bought into recent IPOs, and this is again public information, so we can talk about it. Let's say Zaggle. The bulk deal data did indicate that you've bought into it. You made, Canes, another stock where you bought into public. So how come you've changed what the house always has believed in? Don't buy and invest in IPOs.
So, see, market, I have learned from Rakesh Jhunjhunwala, there is one rule, there are no exceptions in this market. There are, you have to understand in an early cycle, in an early IPO cycle, there are some companies that come to the market which provide you that opportunity. If you see, the IPO market had actually dried up for almost 2 years. This was the first lot of the companies that is coming to the market. Yes, we understand the acronym, it's probably overpriced. No doubt about it. IPO's seller at the other end is an insider who understands the company and business very well, and buyer is somebody who's just a secondary market investor. So that mismatch is there. However, factoring in for that, if there is a good quality company, if we have mentally prepare ourselves that post listing, if the stock was to fall 20-30%, we will buy more. If that kind of mental preparation is there and that kind of commitment we give to a particular company, that is what gives us the comfort that we will build a position during IPO, post IPO also if required, if the stock corrects itself. So there are always exceptions available to the rule in everything. So I hate generalizations. I don't want to generalize everything. Like today, everybody is saying mid and small cap is overheated. It's a generalization. And can you not find companies within that basket of 500, 700 companies which can generate returns? Yes. For somebody who's like a big mutual fund manager, for him probably it's a big problem to move capital from one category to another category, and it is a reflection of the general state of that. But for a stock picker, for somebody who's specializes in identifying sectors and companies, it's okay. We understand that general bullishness is there in that space, but you can still identify your companies, and there will always be exceptions, and we focus on identifying those.
Ravi, over the years I've interacted with you, always admired Rakesh Jhunjhunwala. You've always admired Radhakishan Damani, but the house you represent also has some of the finest investors, your elder brother Kalparaj. I never see you saying good things about him.
So he will hate speaking anything publicly about him. So I'm not going to say anything except that I have learned a lot from him.
Okay. I'm going to change gears now. I hope you'll appreciate that spirit of my question. But if one has to invest the ValueQuest way for next 3 to 5 years, and someone who cannot, invest with you, size could be a constraint, your cutoff in terms of is a constraint. What is your way of investing more 3 to 5 years in terms of themes and sectors?
So we already touched upon it earlier in the show. Financials, manufacturing, energy transition are 3 themes which we believe have a strong tailwind, and they fall in the bucket of where the outlook remains strong. And financials, in fact, falls in the bucket of where the valuations also, from a historical perspective, remain very attractive. For manufacturing and capital goods, probably that's not the case. Some of the growth is already factored in. But the tailwinds are strong enough for us to say that any kind of a correction, serious correction, would be an opportunity to buy. There are other sectors which fall in a kind of a different category, which is the consumer discretionary, where the outlook is actually very weak from the near-term perspective, and the valuations have not corrected much. But if the valuations were to correct over there because of the weakness in the sector over the next 2 quarters, that is one space that we are keeping on our radar where we would like to pick some good quality companies.
But you're not taking a big cash call. You don't think market levels are such that you need to sit on very strong or high levels of cash?
So cash calls are very few and far in between. Last 13 years we have seen everything and we have not taken a major cash call. Usually what happens is when I say we have trimmed a little bit of defense, railway and manufacturing, that automatically has created some cash. Now it's not a cash call on the market, but and that cash has been created and we are waiting for the next opportunity to show itself. So in some of the portfolios in the older portfolios we are sitting on probably 10-15% kind of cash. In the newer portfolios we are sitting on almost 60-70% kind of cash. So again, this is just coincides with the market's overall kind of exuberance level. So we will probably end up deploying as and when the market corrects itself.
So the fresh
or if the outlook changes.
So the fresh inflows you're not looking at, you are not in a hurry to deploy right now. You will stagger it.
Yeah, of course, absolutely. There is no, I mean, we don't follow a model portfolio where you have to, these are the set of stocks, deploy straight away. There are times when we have deployed on day one, whatever cash inflow comes in, and now these are times where you actually have to wait to find an opportunity. So, and hopefully the way the markets reacted on Monday will throw up some opportunities.
What else is keeping you busy?
No, nothing else. Markets and festive season is what's keeping us
cricket?
busy. Cricket season begins now. Yes, it will start now.
Just to wrap it up, one final point. India romance always has been consumers. If I look at the consumer per capita in India, it's at 2,500 crore. As India moves from 3.5 trillion to 5 trillion, 5 to 7, 7 to 10. Well, there should be a massive uptick in the binge spending. How come you're not preparing your portfolio to capture that binge spending?
So as I mentioned earlier, we look at a 3 to 5 year horizon, and outlook in the near term for the consumer is not that great, as for the reasons we discussed earlier.
Not even niche consumers.
Of course. So we do have some presence in the consumption space as well, but that hockey stick growth that we are expecting is probably, it's still not begun, or it's actually probably going to be from category to category. We have seen some of it pan out for, say, building material companies, or we have seen some of it pan out for consumer electrical companies. But pure consumption, it's that move from $2,500 to $4,000 as it happens. The general buoyancy in the economy is still not being felt. It's not widespread. As you mentioned earlier, it's still restricted to some pockets. And that is why the overall consumer stocks are still not doing well. And there are some inflationary trends on the raw material side as well, which is kind of impacting the consumer stocks. But it remains a secular theme for us, and we will always be looking out for opportunities in that space.
Every time you come on the show, I'm going to do it live. I'm just going to open my Twitter and see if there are any questions coming, and I'm going to do it live. It's not a pretend. And there you go. Good to see Ravi Dharamshi on ET now. Before you wrap, Nikunj sir, please ask for a tip.
I know that's a pretend. That's not live. The tip is, I think, a lot of people are scared of what's happening globally. Rightly so. I think US has probably put themselves in a corner because of the kind of fiscal deficit they have, and the kind of interest rates rise that we have seen in US is probably going to have its second order impact. There will be a recession and there will be a tough economic environment in US going forward. And this is coming on the back of a 13-14 years of fantastic stock market performance, where the margins are at peak also. So this is going to be a tough decade for US going forward. But India, on the other hand, is actually being very counter-cyclical. And so one end is US, second end is China, where China has probably shot itself in the foot, or probably their priorities lie elsewhere. Giving a boost to the capital markets does not seem to be their priority right now. They have other priorities. So that is leading to India being the other large market, which is now coming on the radar of a lot of people, lot of long-only funds, endowments funds, sovereign wealth funds. So I expect a lot of money to flow in. Historically, FIIs have owned as much as 25% of the entire equity of India. Today, that's hovering around 17%. So it's not like they are severely overweight or there is over ownership of FIIs in India. So I expect India to reach $5 trillion economy. I expect the corporate PAT to GDP to go from currently 4.1% to about 7-8% over the next 4-5 year horizon. If that happens, then it will be probably a $300 to $400 billion kind of a profit, corporate profit. And if I had to give it a 20 multiple, what it is getting right now, it most likely will be a $6 to $7 trillion kind of a market cap. We are at about $3.7 trillion market cap. If India was to double its market cap, I am sure we can find enough opportunities where we can go 3x to 5x in a 5-year horizon. I think any kind of a crisis in global markets which leads to selling in India will be a great point of entry point for Indian investors.
Before I wrap the show, it's a special show for me because they say 10 is a decade, and it's been over 10 years we've been interacting with Ravi. From an unknown, start to a unforgettable franchise. Last 10 years, I mean, Ravi, my sincere compliments. You blossomed as an original thinker. I mean, what a franchise you've created with this kind of, whole investment approach. It's kudos to you. So it may not be a very special show for you, but it's a special show for me because we complete 10 years of interacting with you on ET now. So thank you very much. And my sincere compliments.
Thank you so much.
Sometimes you get thrilled, sometimes you get excited, but I think it's been a pleasure tracking your investment journey on ET now.
Thank you so much.
That's it on this edition of Market Makers. Thank you for tuning in. Thank you for watching the show.